Hello, everybody. Welcome to this weekend's episode of the Weekly Wrap. This week is episode 16. I invite you to subscribe to the channel and follow us wherever you listen to podcasts. I release one of these episodes every weekend, and I release a shorter episode every day that the market is open. And I titled this Stocks on Sale because there's a lot of fear in the markets right now, a lot of negative sentiment, and I'm not here to say that we're at the bottom. Maybe we are, maybe we aren't, but I think there's too many people that are thinking to sell stocks, sell their assets now, instead of buying them when they're on sale, because ultimately that's what's happening right now. We won't be in this unstable environment forever. We won't be in this environment of inflation and the Fed raising interest rates harder than they ever have in history. That's not going to last forever. Any market doesn't last forever, but when you take a step back and you see a market and it's an extreme, so obviously we're in an extreme market right now when it comes to an inflation. We're in an extreme market right now when it comes to the Fed raising interest rates. You could make the argument that we're in an extreme market right now as far as negative sentiment. We're in an extreme market as far as geopolitical tensions. We're in an extreme market as far as domestic political things are going. And so when you see all these extremes, you can make the conclusion that not only are they not going to last forever, but usually extremes hang around for less time than a normal market because you need to revert to the mean. So I say that to say that this environment that we're in, even though it's not good for stocks, it's not good for your assets. I mean, your portfolio is probably going down. It's not going to be this way forever. Selling now is just not something you want to do. You want to buy assets when they're on sale. This is how you get in at good prices. And valuations are starting to come down now where we're starting to see them more towards a historical average. And so it can be a good time to start investing or to continue investing every single month. I'm of the belief that dollar cost averaging in the same amount every month is the best way to go. It protects you in bull markets. It gives you that insurance of getting in at good prices in bear markets. It's just consistent investing is really the best way to go, and the math backs it up. So the first thing I want to talk about is the Federal Reserve, because this week was the first time that we heard them say anything that deviated from we're going to continue to raise rates as aggressively as possible. Inflation's out of hand. We're going 75 basis points every single month. That's really what we've been getting for the past few months. But this month, or not this month, but this week, we heard that they're thinking about slowing down the pace of rate hikes. And so in November, we'll see a 75 basis point hike most likely. But then after that, we could see a drop to 50 basis points and then continue from there. And so what's that mean? It means we're getting close to the peak of interest rates. We're not there yet, but we're getting closer. We're getting an indication that we're starting to slow down that interest rate hike cycle. And it's not something to overreact to and think that we're just going all bullish from here, but it's a sign, it's a good sign for an indication that maybe we're near the bottom of these markets. Typically, you see markets bottom around 6 months from the last rate hike. And if in the December meeting we're going to see maybe the beginning of slowing down rate hikes, then we definitely could be around 6 months from that last hike. And that's definitely something that we need to be aware of, because that would be a huge macro shift if they do continue with this. And I think a lot is going to depend on what we get from the CPI in the next few months as well. So this is definitely going to be an elongated process. Like, they're going to have to see the data of what's going on. And I think the data is going to push them to lower interest rates or not lower interest rates, but keep slowing down and maybe get to that peak interest rate, because the CPI really, to me, is a lagging set of data. So we might see what right now how that's affecting inflation with the 75-point hikes every month. We might see that in the CPI data as they're starting to slow down on interest rate hikes. And then they'll say, oh, okay, so inflation's going down. We can start slowing in interest rates, but we won't really see the effects of that until later. So while that is a little bit dangerous, I'm just here to give you the facts, and that's probably what's going to happen. Obviously, the stock market is probably going to go ballistic as soon as the Fed says that they're done raising rates or they're going to start cutting rates. The stock market is going to go into an uptrend. I don't care what the technicals look like then. I don't care what's going on in the world. As soon as the market gets a hold of the fact that the Fed is going to stop raising interest rates, they're going to start cutting. Even before they say they're cutting, even when they say that say we get a 25 basis point hike, or say they keep interest rates flat for a month, the stock market's going to go ballistic. That's just what I think. Every single bear market rally we've had has basically been fueled off the fact that of just like this hope that the Fed's going to stop raising interest rates, that they're going to pivot. And so I think when that actually does happen, you're going to see a huge, massive rally in markets. And maybe they cool off a little bit after that to grapple just like with the reality of the economic situation. But I think we see a change of trend when that happens. The beginning of a change of trend. You won't be able to know it's a change of trend until we cross over that 200 or that trend line that we have on the charts. But I do think that that's going to be a big deal. And the fact that we're starting to just hear the very beginning of that process, that, hey, we're starting to think about slowing down the pace of what we're raising interest rates by. It's not inherently bullish, but it's a sign that there are things changing at the Fed, and it's something that we all need to be aware of as investors, because that's really been fueling this market since the and before the pandemic. But the Fed's had a big hand in the price action on the stock market as far as the rally after COVID. We're really still in we've been in one big recession since the pandemic, since the shutdown, honestly. And the only reason we saw this artificial growth and the stock market just being pumped up was because of the Fed. The stimulus, the zero interest rates, it was all just this facade by the Fed, and now we're seeing that they're taking that away. They're taking that easy money away. The interest rates are rising, and now you're seeing deterioration on the market. So it sucks that the Fed has that much of a hand in what happens like that, but it is our reality, and so we need to be aware of it, whether we like it or not. So I wanted to take a look at this chart again because we haven't looked at it in a while, and it's giving us the weekly sentiment here. And you can see we've been pretty bearish now for about a month. And typically when you see sentiment like this, the markets can only go down so much harder or aggressively when everybody's bearish. Typically you see those big sell-offs when maybe the market switches to a more bullish sentiment during a bear market rally or whatnot. And we've seen some of our rallies in this bear market come from times like this when sentiment has been like this. And so I just wanted to bring it up because we haven't talked about it for a while. But sentiment is so bad right now. Everyone thinks that we're gonna see this 2008 style sell-off. We're gonna go down 50%, and we might. We definitely can do that. I'm not saying we can't. We definitely can, but you have to tether yourself to some kind of reality, because we're not as leveraged as we were in 2008. I think the banks learned from that crisis, and that maybe there are a couple institutions that are at risk, like Credit Suisse. But I think for the most part, you're not going to see the level of defaults that we did in 2008. I think if any, you'll see Credit Suisse go under, and that's really it. I think the housing market definitely still needs to crash, and that'll affect just the economy in general and probably the stock market. But if anything, I think that a housing crash would be short-lived, affecting the stock market, because I think then the Fed would be more hasty in a slow kind of pivot, because they're in the process of doing this slow pivot where, okay, now we're going to slow down interest rate hikes. Now we're going to stop interest rate hikes. Okay, now we're going to cut interest rates. We're at the very beginning of that process. And I think that process will be pushed forward if we see housing really deteriorate the way a lot of people are forecasting. And while the sentiment will get worse, and that could definitely push markets lower, I think it would push the Fed's agenda a little bit. I'm definitely not saying at all in this episode that we're at a market bottom, go all in. That's not what I'm saying. I'm saying that I'm trying to tether people to reality, I guess, like I said, and that even though this market has more room to go down, we're seeing good prices right now. And if the market continues to go down, that's even better prices. And so I'm putting in all the free cash that I can. So obviously every situation is different. As far as personal finances go, you want to have that cash flow to cover your expenses. You want to have that cash flow to build an emergency fund. You want to have that cash flow for any kind of discretionary spending you want to be able to have, or travel or anything like that. But after all that's covered, any sort of cash flow for me goes into investments. I don't want just big piles of US dollars sitting around. I have an emergency fund for and excuse my cat outside the door crying. He wants me to pet him, but he's not going to get in while I'm recording because that just wouldn't work. So if you hear him, I apologize. But what I was saying was, I have an emergency fund that's in US dollars, so I can cover my expenses for an extended period of time if I didn't have any kind of income. And I have that kind of stashed away, and it works as like a dual fund for that, as well as if assets went down 80%, then I would start moving that cash around to invest. I have another a quote-unquote emergency fund, but it's just a flex expenses fund. So when I like to dip into there before touching my cash reserve, my emergency fund. Don't really like to touch the cash reserve. I like to just have that there. And then I kind of use that expenses fund as the just unexpected things that come up. Then that's what I use. And then I have a discretionary spending bucket that I just use if I want to buy something. It just pops up. That's what I dip into. I'm out and I go out. That's what I use. I have a travel fund, and then after that, everything goes into investments. And so I have a chunk in Bitcoin as just this reserve in digital assets. I have a little bit of Ethereum. I don't really have the conviction in Ethereum as I do in Bitcoin, but I kind of use that to hedge my Bitcoin bet a little bit. But I definitely hold a lot more Bitcoin than I do Ethereum. Then everything else goes into stocks, and then obviously I'm saving for real estate investments and such. But I think people, they sell their assets, but you got to think about the trade-off that you're doing. So you sell your asset, say you sell a bunch of your stocks, and now what? You're sitting on a pile of cash in this environment where inflation is at best, if we print 0% for the rest of the year, is going to be over 7% year over year. That's what you want. You want your money to be deteriorating by 7% year over year. That's not what I want. So I think people just they sell, but what's after that? You're trading a company or a fund for US dollars, and that's what you want. You want US dollars. I don't want US dollars. In our economic environment, no, I don't want to just hold on to US dollars as some sort of investment. So you really have to think about the opportunity costs and the trade-offs that you make when you do that. So that's just what goes through my head. If I see we were just seeing great prices right now, or good prices, and great prices in some places, that makes me want to invest. It makes me want to buy. I have a long time horizon. Hopefully, I don't even have to sell all these assets in my lifetime. You can continue to pass them down. And so this is really when you want to be investing. And this chart shows that most people don't understand that. So this chart also is just kind of like more in depth of what I just showed you. This is a deeper just sentiment model from Sentiment Trader. I really like this account. I recommend you follow it on Twitter. I really love the charts that they post, and you'll see when sentiment is this low in the market, you can see the times it's been correlated with. So the last time we went below this green dotted line was the bottom in COVID. The time after that was the bottom in 2019 in that little bear market. And you can see that every single time we've crossed below this green dotted line, it's indicated a relative low in the market. And so we're there now. That doesn't mean we can't go deeper below and go deeper down on the stock market, but it's to say that we don't usually stay here for that long, and we usually see stock prices go up afterwards. So again, when you see this many people in despair, this many people selling, this many people giving up, just walking away from the stock market, it's something you should be aware of, and that's when you should swoop in. Warren Buffett says the best time to be greedy is when everyone else is fearful. Everyone's selling their assets, so the prices are cheaper, and that's when you go in and you scoop them up, and then you hold on to them or you sell them when they're higher. Just this environment right now is not a good environment to sell assets by any means. When the market's down, it's never a good time to sell, but especially now with inflation where it's at, like I just don't understand why anyone would want to sell a high quality asset for US dollars and just have it sit around. I can understand if you're selling it to make a different type of investment, and if the thesis is good and you have conviction, okay, that's a different story. But just to sell so you can have a pile of cash, it just doesn't make sense. Does not make sense. So let's look at the midterm cycle that we're in right now. So obviously there's a lot of different scenarios here as far as midterms go. They have all years in black, all midterm years in blue, the first term midterm year in green, the purple Democratic president midterm in purple, and then the second year new Democratic president in red. So we are in all these scenarios right now. So obviously all years, that is us. All midterm years, that is us. First term midterm year, that is us. Democratic president midterm, that is us. And a second year new Democratic president, that is us. And you can see that we'll hit this low typically near the end of October, so where we're at right now, and then through November, December, the end of the year, you really get that rally. You typically see a rally at the end of the year anyways, but definitely in midterm years you do. Usually in a midterm year you see a little bit of chop in the markets throughout the year, which we've seen a little bit more than chop, but you get that rally through the end of the year, whether that's a bear market rally and we come back down or we're at a bottom right now. I'm not going to sit here and call a bottom because that's just irresponsible, but I can make conclusions as far as relative bottoms. Maybe we're about to get a rally or something like that. You can look at the data and make those types of conclusions, but be wary of people that online that are calling a bottom or a top. Usually they have some kind of agenda, or they're just bad investors, or they're just irresponsible, or a combination of those things. Let's take a look at some charts now, though. Let's look at the S&P 500. So we've had a lot of chop around the zone right here. Excuse me while my cat just absolutely bangs at the door. She obviously doesn't understand. I have two cats. That's why I said he earlier and she right now. Obviously, they don't understand that I'm trying to record an episode right now, but they're small and cute, so it's okay. Okay, so let's look at this chart. So we were in a pretty aggressive sell-off from the last time we touched this trend line. We touched the 200 moving average at the same time. We've been coming down, with the exception of this little 4-day rally right here. Now we've experienced a lot of chop around this low that we had in June. We actually breached below, and we've come back up since then. Here's the thing. This upcoming week is earnings. We got a lot of earnings, got a lot of big companies reporting. And even though the technicals are looking kind of bullish right now, that can get wiped away if, say, Apple, Microsoft, Meta, Amazon, Alphabet, let's say those companies disappoint, or the majority of them disappoint. They're lackluster. I really do think you could see the markets get killed. And maybe I could even draw another trend line on the chart that comes through here. Maybe not, but I think we need to be cautious of that. On the flip side, let's say they blow it out of the water, these big companies, and they haven't really seen any kind of earnings recession, anything like that. The market will definitely continue to bull higher in that scenario. And so the next level of selling pressure that we'd see is up here around the 3,800. And then after that, I think this 200 moving average will act as some resistance. If we break through that, that would be pretty significant. Obviously, we'd got to break through this trend line too. On the flip side, to the downside, obviously this area is going to cause some issues for us till we make a clean break. After that, I've said the 3250 is my target on the S&P 500. I really don't know what's going to happen on the market this week because I think it really depends on earnings. Even though we've been in this pessimistic kind of slide, I don't know if the market's going to look too deep into the Fed saying that they're looking into slowing the pace of hikes. I don't know how that'll affect the market. If it does, it's going to be a bullish effect, kind of like with what we saw on Friday. But I think really it's going to depend on the earnings. So if I just think that if the earnings are bad, that we're going to continue to slide a little bit. And if it's good, then I do think that we could go into a little bit of a strong rally here because now you have real evidence that the Fed's maybe in this process of pivoting. And when I say pivot, that takes months, right? Like they're going to slow down the pace of the hikes, then they're going to stop the hikes, and then eventually they'll start cutting the rates. And we saw what happened here through June and July into August when we just had there was literally no kind of evidence, nothing to say that the Fed would pivot, just hope, and this is what happened. So if we get real evidence, which we got, and good earnings, it could push us up. So a lot of variables on the S&P 500 like to bring you both sides. So that's what I'm looking at. Bitcoin, I mean, same story. It can't get any more boring on Bitcoin, honestly. I'm waiting for this to crash through. So it's been flat for 4 months. Obviously, we've talked about this level. If it gets breached, the target is 9,000 to 12,000, and I've been saving money for that. I've got a little pile of cash going, and instead of dumping it all in right now, I'm gonna wait for that better price because my opinion is that we will break through this zone and we will get the 9,000 to 12,000 target. Obviously, that might not happen. Do your own research before making an investment decision, but that is what I am doing. We broke through this trend line that's been on the chart for a year. It's been holding, and we saw weakness. So I think that Bitcoin investors and the Bitcoin market is waiting for another sell-off in the stock market, or I'm not sure what they're waiting for if they're not waiting for that. Because it's been really correlated with the stock market. There's been a lot of really good things coming out of the Bitcoin world, which just drives my conviction even more. But I think that it's so early that people don't even know how to trade it. And so it's just been trading like a high volatile NASDAQ stock. But I think if we see another leg down, then we'll for sure see that break. There's definitely more of a chance that we bottom out here if the market has hit its bottom already, but we don't know. So that's what I'm looking at on Bitcoin. It's really weak. It's really weak, and it should have been strong breaking through this trend line, and it's weak. So I'm expecting another leg down there, but do your own research, obviously. So I wanted to make this video to kind of bring people to reality that it's not all bad, that there are assets on sale. You don't be scared out of your investments. Get that consistent investment flow going. Don't just sit on US dollars to sit on them. I really do appreciate you watching or listening to this episode. If you like these episodes, I release one every single weekend, so be sure to subscribe on YouTube and follow wherever you listen to podcasts. And I also release a short episode every day that the market is open, so subscribe and follow for that as well. But I appreciate your ears or your eyes, however you consumed this episode on Spotify, Apple Music, YouTube, whatever. I appreciate it, and I will see you in the next episode.